Imagine a gold mine where every 4 years the amount of gold you can extract halves. That, in essence, is Bitcoin halving. This is the crux of a fascinating and unique aspect of the world's first decentralized cryptocurrency, Bitcoin. Invented by the enigmatic figure known as Satoshi Nakamoto, Bitcoin was ingeniously designed to mimic a precious metal in the digital realm. Much like how gold miners extract less and less gold over time, the Bitcoin network is programmed to produce fewer new Bitcoins as time goes by. This happens approximately every 4 years in an event that's come to be known as the Bitcoin halving. During this halving event, the reward that miners receive for adding new blocks to the Bitcoin blockchain is cut in half, hence the term Bitcoin halving. This built-in scarcity is part of what gives Bitcoin its value. Now that we have a basic understanding of what Bitcoin halving is, let's delve into its historical impact on Bitcoin's price. Take a step back to November 28, 2012, the date of the first Bitcoin halving. The year was 2012, just 3 years after the birth of Bitcoin. Miners were rewarded with 50 Bitcoins for each block they mined on the blockchain. But on that particular day in November, something unprecedented happened. The reward for mining a block was slashed in half, from 50 Bitcoins to 25. This event, now known as the first Bitcoin halving, was built into Bitcoin's code by its mysterious creator, Satoshi Nakamoto. So what happened next? Well, the impact wasn't immediate. It was more like a slow burning fuse leading to a fireworks display. Over the next several months, the price of Bitcoin began to climb. From a humble value of around $12, the price soared, reaching over $1,100 by the end of 2013. This was a significant growth, signaling the power of halving events to spur substantial price increases. But why did this happen? Quite simply, it was a matter of supply and demand. With the reward for mining cut in half, fewer new Bitcoins were entering the market. This scarcity, coupled with a growing interest in Bitcoin, led to increased demand. And as we know, when demand outpaces supply, prices rise. However, it's important to remember that the Bitcoin market is influenced by many factors, not just halving events. External factors such as regulatory changes, technological advancements, and shifts in market sentiment all play a role in Bitcoin's price. But there's no denying that this first halving event marked a significant milestone in Bitcoin's history. The first Bitcoin halving set the stage for a significant price increase. But was it a one-off event or a trend? Let's find out. Fast forward to July 9, 2016, when the second Bitcoin halving took place. This event was another pivotal milestone in the world of cryptocurrency. The block reward was further sliced in half, dropping from 25 Bitcoins to just 12.5. Now, this might sound like bad news for miners, but remember, scarcity often drives value. In the year leading up to this second halving, there was a noticeable uptick in Bitcoin's price. People were starting to catch on to the pattern. The value of Bitcoin was not just holding steady, it was climbing. The anticipation of the halving seemed to create a buzz, an excitement that fueled this increase. And this upward trend didn't stop with the halving. Quite the contrary, it continued over the subsequent months. But why did this happen? Well, it's a combination of factors. The reduced supply of new Bitcoins entering the market puts pressure on the demand side, which in turn can drive up the price. Plus, the publicity and hype surrounding these events also attract new investors to the market. Their increased demand for Bitcoin can further push up the price. But it's not just about supply and demand. There's also a psychological component at play here. These halving events are a stark reminder of Bitcoin's scarcity. There will only ever be 21 million Bitcoins. And with each halving, we're getting closer to that limit. This scarcity factor can induce a sort of fear of missing out among potential investors, which again, can drive up the price. So what does this all mean? Well, it suggests that Bitcoin's design, with its built-in scarcity and predictable supply reduction, can create conditions for price increases. And this isn't just speculation. We've seen it happen not once, but twice. A second significant price increase following a halving event. Coincidence or correlation? Let's examine the third halving. May 11, 2020 marks the date of the third Bitcoin halving. This significant event saw the block reward for miners halved yet again, this time from 12.5 Bitcoins to a mere 6.25. This reduction was not a surprise, it was part of Bitcoin's design, a pre-programmed event occurring approximately every 4 years, or after 210,000 blocks have been mined. Leading up to this third halving, Bitcoin's price had been on an upward trajectory. The anticipation of the event seemed to have stirred the market, and investors were keenly watching the cryptocurrency's performance. But it was after the halving that things really started to heat up. The price of Bitcoin did not just increase, it soared. The cryptocurrency embarked on a bull run that extended well into 2021. From hovering around $8,000 in May 2020, Bitcoin reached unprecedented heights, touching nearly $60,000 by March 2021. This was a price surge of monumental proportions, the likes of which had never been seen before in the Bitcoin market. This price action was not an isolated incident. It mirrored the patterns observed after the first and second halvings. Each time, the halving event was followed by a significant increase in Bitcoin's price, creating a wave of profits for those savvy enough to ride the tide. So what was the impact of this third halving? It's clear that it contributed to a dramatic increase in Bitcoin's price. This, in turn, brought Bitcoin into the mainstream spotlight like never before, sparking global interest and debate about the future of cryptocurrencies and blockchain technology. But it's not just about the price. The third halving also highlighted the fundamental principles that make Bitcoin unique: its finite supply, predictable issuance rate, and the security of its decentralized network. These aspects were brought to the forefront, leading to deeper conversations about Bitcoin's role in the global financial ecosystem. 3 halvings, 3 significant price increases. What does this mean for Bitcoin enthusiasts and investors? Well, history seems to suggest that halving events are a precursor to price surges. However, as with any investment, it's essential to remember that past performance is not a guarantee of future results. The world of Bitcoin is a thrilling ride, filled with highs, lows, and plenty of unexpected twists along the way. Bitcoin halving events have been a goldmine for early investors, miners, and traders. Let's dive into how these different groups have reaped substantial profits from these pivotal moments in Bitcoin's timeline. Starting with early investors, those who had the foresight to invest in Bitcoin before the halving saw their investments balloon in value. Consider this: after the first halving in November 2012, Bitcoin's price catapulted from around $12 to over $1,100 by the end of 2013. That's almost a 100-fold increase in value, a dream come true for any investor. Next, we have the miners. Yes, the block rewards were halved, but that didn't spell doom for them. Quite the contrary, the surge in Bitcoin's price following the halvings often offset the reduction in rewards. For instance, miners who were able to keep their operational costs down found the business even more profitable after the halvings. Then there are the traders, the astute ones who could accurately predict the price fluctuations around the halving events. The increased volatility and price surges provided a fertile ground for savvy traders to make a killing. Some employed various strategies to ride the wave of these market dynamics, turning the halvings into an opportunity for profit. Lastly, we have the long-term holders. These individuals, often referred to as hodlers, have seen their investments grow significantly over time, thanks in part to the halvings. Holding on to Bitcoin through multiple halving cycles has often led to substantial profits. It's a testament to the old adage, patience is a virtue. In conclusion, Bitcoin halving events have been more than just a technical adjustment in the blockchain protocol. They've been a catalyst for significant price increases. And those who have been able to capitalize on these events, be it early investors, miners, traders, or long-term holders, have seen significant profits. Bitcoin halving events have historically led to price increases, and those who have capitalized on these events have seen significant profits. Bitcoin halvings are more than just a technical event in the Bitcoin network. They are pivotal moments that have historically sparked significant price increases. From the first halving in 2012 that saw Bitcoin's value rise from around $12 to over $1,100, to the third halving in 2020, which kicked off a bull run extending into 2021. These events have shown us the potential for substantial gains. Whether you're an early investor, an efficient miner, a savvy trader, or a long-term holder, the key takeaway is this: Understanding Bitcoin halving can provide valuable insights into potential Bitcoin price movements. So stay informed, stay ready. If you found this content informative, please like the video and subscribe to the channel. Your support enables us to bring you more quality content. And remember, the world of Bitcoin is full of opportunities and knowledge is the key to unlocking them.